Hi, I'm Janie from Sturgeon Bookkeeping, and in my last video, I introduced the 3 financial reports that every business owner should be looking at: the income statement, or P&L, the balance sheet, and the cash flow statement. Today we're taking a closer look at one of them, the balance sheet, what it actually shows, what most owners get wrong when they look at it, and the 3 numbers that you should be pulling from every single month. So let's get started. Your balance sheet isn't telling you what your business is worth, but it's one of the most common misunderstandings out there. So here's something that trips up a lot of business owners. Someone looks at the balance sheet, sees a number next to the word equity, and thinks, well, that's what my business is worth. Great! But it's not. And honestly, it makes total sense that it looks that way. It's the closest thing on the page to a final number, but it's not a price tag. So here's an easy way to think about it. You own a vehicle that has a book value, but if you were to sell that vehicle tomorrow, someone might pay you twice as much because your vehicle runs great and it has low mileage. So the same idea with your business. The equity number on your balance sheet, well, that's an accounting number. It's a running tally of what you've put in, what you've kept, and what you've taken out over time. What someone would actually pay you for your business, well, that depends on your clients, your reputation, your revenue, and 100 other things that never show up on a balance sheet. So when you look at that equity number, just know that's what you have on paper. That's not what your business is actually worth. Every balance sheet has 3 buckets, but most business owners only pay attention to the first one. So let's break it down. The first bucket is assets, everything the business owns, cash in the bank, inventory, and money that clients owe you. If the business owns it or is owed it, it goes here. And money that clients owe you go into an account called accounts receivable, or AR. The second bucket is liabilities. It's everything that the business owes. So loans, credit card balances, unpaid bills, and money that you owe your vendors and suppliers. If the business owes it, it goes here. Money that you owe your vendors and suppliers goes into an account called accounts payable, or AP. The third bucket is equity. It's what's left after paying off everything the business owes. So if you sold everything and paid all of your bills, what's left is yours. Assets minus liabilities equals equity. That's the formula. One more thing worth knowing. Assets and liabilities break down into 2 groups, current and long-term. Current, it means within 12 months. Long-term means beyond that. So examples of current assets would include cash in the bank, or money that you expect, invoices that you expect your clients to pay soon. Long-term assets would include equipment and property. Current liabilities would be bills that are due soon, where long-term liabilities would include a business loan that's going to take years to pay off. You'll hear these terms again when we talk about ratios. Something to keep in mind is that some assets will be showing at accounting value, not market value. So your work vehicle, it might be worth $30,000 at market value, but it may only show $18,000 on the balance sheet. This ties back to why equity isn't your business's price tag. But here's where many owners go wrong. They only look at what they have, but what you owe matters just as much. If your debts are growing faster than your bank account and your assets, your business is actually getting shakier, not stronger. For example, a business that has $500,000 in assets but has $480,000 in liabilities is carrying a lot more risk than a business that has $100,000 in assets but only $20,000 in liabilities. Bigger doesn't always mean healthier. You really have to watch both sides. Here's the thing about your balance sheet that trips up a lot of business owners. Your balance sheet is a picture of one specific day, not a month, not a year, one day. So December 31st, or June 30th, or today. Whatever date it's run for, that's the only day's balances that it's capturing. So, which means if you collected a large payment yesterday and paid a large bill tomorrow, your balance sheet on those 2 days would look very different, even though the underlying business is the same. That's why you can't read your balance sheet in isolation. It needs to be read alongside of your income statement or P&L, which shows whether you've made a profit over a period of time, and your cash flow statement, which shows where the money actually moved. On its own, the balance sheet is like looking at a single photo from a road trip and trying to figure out where you went. You really need the whole album to understand the journey. One report, one day, one piece of the puzzle. That's what it is. And that's exactly why you need all 3 reports. Remember, a profitable business can still run out of cash. No single report tells the whole story. If you only calculate 3 things from your balance sheet every month, make it these. Fair warning, a little math coming up. Nothing scary, just 2 simple divisions that give you 2 really powerful numbers. Number 1, your current ratio. Divide your current assets, the things you can turn into cash within the next year, by your current liabilities, the bills you owe within the next year. The result tells you how many dollars of short-term assets you have for every dollar you owe in the next 12 months. For example, if you have current assets for $60,000 and current liabilities for $12,000, you'll take your current assets at $60,000, divide by your current liabilities of $12,000, and that gives you 5. This means that for every $1 you owe in the next 12 months, you have $5 in short-term assets to cover. Very healthy. If that number drops below $1 for every dollar you owe, it's usually a warning sign that cash could get a little tight if the bills come due before more cash comes in. One caveat, some industries normally run below 1. If you're in one of those, talk to your CPA about what's normal for your type of business. Number 2, your debt to equity ratio. Divide your total liabilities by your equity. This tells you how much of your business is funded by debt versus your own money. A higher number means the business leans more heavily on borrowed money, which is fine in some situations and worth watching in others. Some industries normally carry more debt than others, so context always matters. For example, if you have $24,000 in total liabilities and $48,000 in equity, you will take your $24,000 in total liabilities, divide by your $48,000 in equity, and that gives you 0.5 or 50 cents on the dollar. This means that for every $1 in equity in your business, you only owe 50 cents in debt. You own more than you owe. Healthy and a good place to be. Number 3, the pattern of both. Pull your balance sheet on the last day of every month and then line them up side by side. 3 months compared starts to show you something valuable. Are your ratios improving? Is equity growing? Are your debts creeping up? You don't need a fancy chart. A simple table with 3 columns, one for each month, tells you everything you need to know at a glance. Pull these 3 things
every single month, and you will catch problems months before they turn into emergencies.
So that's the balance sheet, what it actually shows, where business owners get tripped up, and the 3 things worth calculating every month. In my next video, I break down the income statement or P&L, what revenue really means, why expenses have 2 very different categories, and what your gross profit number is actually telling you. Subscribe so you don't miss it. Give this video a like if it was helpful. Please share with another business owner who could use it, and leave me a comment below with topics you'd like for me to cover. I'm Janie with Sturgeon Bookkeeping. Thank you so much for watching. I really appreciate it, and have a great day.